Welcome to the Explainer. So today we're going to dig into a really fundamental principle for any smart investor, diversification, and specifically how we apply it to the massive, complex world of commercial real estate.
This is the question every single real estate investor has to ask themselves, right? How do you put together a portfolio that doesn't just survive the ups and downs, the market cycles, the crazy interest rate shifts, all the unexpected curveballs, but actually thrives through them? The answer, you'll see, isn't about finding that one magical property. It's about how you build the entire collection. And this is where we run into what you might call the investor's dilemma, concentration risk. I mean, it's so tempting to go all in on that one can't-miss apartment building, or to become the absolute expert on, say, medical office buildings. But what happens if the big local employer in that city suddenly packs up and leaves? Or what if regulations change for medical practices? All of a sudden, that laser focus can become, well, devastating. And the answer to this problem? Well, it's a word you've heard 1,000 times: diversification. But let's get specific, because we're not just talking about randomly buying different stuff. It is a strategic practice. The whole idea is to build a portfolio where the weaknesses in one asset are canceled out by the strengths of another, giving you a much smoother, more stable ride in the long run. Okay, so that all sounds good in theory, but how do you actually do this in the real world of commercial real estate? Well, the best way I've found to think about it is to break it down into a few foundational pillars. Think of these as the core building blocks you need to create a truly resilient portfolio. Now, you could slice and dice this a bunch of different ways, but we're going to focus on the three big ones: what you buy, where you buy it, and how you're planning to make money with it. So that's property type, geographic location, and investment strategy. Let's dive into each one. All right, let's kick it off with pillar one, property type. What's so fascinating here is that each of these sectors kind of dances to its own economic beat. Think about it, a recession could absolutely hammer cyclical assets like hotels, right? But at the same time, people always need a place to live, which keeps multifamily assets pretty stable. Or look at the e-commerce boom. It sent industrial and logistics properties to the moon, while the shift to remote work created huge problems for traditional office spaces. By mixing these up, you're not putting all your chips on a single economic trend. And you know what? This exact same logic applies to our second pillar: geography. It might feel super safe to only invest in big gateway cities like New York or LA. You get stability, sure, but your potential returns, your yield, is usually lower. On the flip side, a smaller, fast-growing city might offer way better returns, but it also comes with more risk and volatility. The sweet spot is often in the blend, getting that bedrock stability from primary markets while also chasing that growth potential in other places. And that leads us perfectly into our third and final pillar, investment strategy, which is really all about understanding the relationship between risk and reward. See, it's not enough to just own different types of buildings in different cities. You also need to diversify the actual game plan for each asset. And this table, man, it just lays it all out so perfectly. On one end of the spectrum, you've got core investments. This is your stabilized, fully leased office building in a top-tier location with a tenant that's going to pay rent for the next 20 years. It's lower risk, and you're just looking for steady cash flow, maybe 6 to 8% returns. Then, way over on the other end, you have opportunistic. This is ground-up construction, or maybe turning a failed mall into something completely new. It's super high risk, but you're swinging for the fences, targeting returns of 15% or even higher. And everything in between, core plus and value add, is a mix of both. So here's the bottom line, right? Your boring core assets are the ones that churn out steady cash flow, helping you ride out a downturn. Meanwhile, your value add and opportunistic projects are where you get the potential for that huge pop in growth. It's this balance across the entire risk spectrum that creates a really powerful all-weather engine for your portfolio. Okay, so this all sounds amazing, right? You just spread your money around and you're golden. But it's not that simple. In the real world, diversification is not some kind of silver bullet. It comes with its own set of very real challenges and trade-offs that every investor has to be smart about. I absolutely love this term, diversification. It's brilliant. It's what happens when you take a good idea, diversification, and push it too far. You spread yourself so thin across so many different property types and markets that you end up becoming a jack of all trades, but a master of none. You lose that competitive edge that comes from deep, focused knowledge. And this really gets to the heart of the matter, this fundamental tension. All the data shows that specialized investors, the people who have deep, almost obsessive expertise in one little niche, often outperform the generalists. So the question is,
how do you spread your risk without watering down the very expertise that drives your best returns? It's a really delicate balancing act.
And there are other big things to think about too. First off, liquidity. Commercial real estate is not a stock. You can't just click a button and sell a building tomorrow. Then you've got operational scale. I mean, actually managing different kinds of properties in different states is a huge headache. And finally, you have to really ask yourself, are my assets truly independent? Owning two industrial warehouses that both serve the auto industry isn't real diversification if the whole auto sector gets hit.
So, with all these moving parts and trade offs, how on earth do you find the right mix for you? How do you take all this theory and turn it into a practical strategy that actually works? And this right here is probably the single most important thing to take away from our entire chat today. The goal is not maximum diversification. It is optimal diversification. You're trying to get rid of that specific, concentrated risk without spreading yourself so thin that you just become average at everything. All right, so how do you actually put this into practice? Well, it kind of breaks down into a few steps. First, you have to be really honest about your own risk tolerance and the scale you're operating at. Second, build that deep, undeniable expertise in one or two core areas where you know you can win. Then, as you grow, you can start to expand, but do it logically, into sectors or markets that are right next door to what you already know. And finally, remember, this is not a set it and forget it kind of thing. You have to constantly be reevaluating and rebalancing as the world changes. And all of this leaves us with one final really big question to chew on. The fundamental ways we work, live, and move things around are changing right before our very eyes. I mean, think about remote work, supply chain chaos, all the demographic shifts. Building a resilient portfolio for today is really about trying to figure out what's going to be valuable tomorrow. So, what do you think that portfolio looks like?